You want to start investing, but picking individual stocks feels terrifying. Bet on the wrong company, and you can watch your money vanish. So you freeze and do nothing. But what if you didn't have to pick a winner at all? What if, with a single click, for the price of a coffee, you could own a tiny slice of 500 companies at once? If one of them collapses, you barely feel it. That's not a fantasy, it's called an ETF. And it's quietly become the most popular way for ordinary people to invest. Let's break down what it actually is in plain English. ETF stands for Exchange Traded Fund. Forget the jargon. Picture a basket. Instead of buying one apple, you buy a basket that already holds a little bit of hundreds of different fruits. An ETF is that basket, but for investments. Inside it might be hundreds, even thousands of different companies' stocks, all bundled together. And here's the clever part. That whole basket is packaged into a single thing you can buy and sell on the stock market, just like one share of a single company. Buy one share of the ETF and you instantly own a sliver of everything inside it. One purchase, hundreds of companies. So why is this such a big deal? Two reasons. The first is diversification, which is just a fancy word for not putting all your eggs in one basket. If you sink all your money into one company and it goes bankrupt, you're wiped out. But if that company is just one tiny slice of a basket of 500, its collapse barely moves you. Your risk is spread out automatically. The second reason is cost. Most ETFs simply track a list, like the 500 biggest companies in America, and follow it automatically. No expensive manager making decisions. That keeps the fees tiny, and as we'll see, that matters more than almost anything. Not all ETFs are the same. The most popular ones are index ETFs. They quietly track the whole market, like the famous S&P 500, which holds America's 500 largest companies. Buy it, and you basically own a piece of the entire American economy. But there are others. Sector ETFs bundle just one industry, like technology or energy. Bond ETFs hold loans instead of stocks, for people who want something steadier. There are even ETFs for gold, for foreign markets, for almost anything. The menu is huge, but for most people, the boring broad one that owns the whole market is the quiet winner. Here's the part the ads leave out. ETFs feel simple and safe, but they are not magic. First, the fees. Even a tiny yearly fee, 0.5%, sounds like nothing. But compounded over 30 years, it can quietly eat a real chunk of your returns. Always check the number, called the expense ratio, and keep it low. Second, some ETFs are traps. There are exotic, leveraged ETFs that promise double or triple the gains, and they can destroy your money just as fast. And diversified does not mean it can't fall. When the whole market drops, your basket drops with it. An ETF spreads your risk. It doesn't erase it. So who is this actually for? If you're someone who wants to invest for the long run without staring at charts all day, a low-cost, broad-market ETF is one of the simplest tools ever invented. You're not trying to be a genius. You're just quietly owning a piece of the economy and letting time do the work. It won't make you rich overnight. And anyone who promises that is selling something. But paired with patience and low fees, it has quietly built more everyday wealth than almost any clever stock-picking strategy. Boring, it turns out, is a feature, not a flaw. Let's land the plane. 3 things to take with you. 1. An ETF is just a basket of many investments that you can buy in a single click, like one stock, and it spreads your risk automatically. 2. The boring, broad, low-fee ETF that tracks the whole market usually beats the fancy, expensive alternatives. 3. It's a tool, not a lottery ticket. Its power comes from low costs and time, not from getting lucky. Next time, we'll tackle the fight this raises. Index funds versus the highly paid experts who try to beat them. And the answer might surprise you. This has been Plain Economics. No jargon, no agenda, just plain.